The world is supposedly running out of copper. So why are the factories that turn copper rock into usable metal suddenly being paid almost nothing to do it? In some contracts, treatment and refining charges, the fees miners pay smelters to process concentrate, have been pushed toward zero. In a few corners of the market, traders have even discussed effectively negative economics. That sounds impossible until you see the bottleneck. Copper is not just dug out of the ground. It has to move from mine to concentrate, from concentrate to smelter, from smelter to refined metal, and then into wires, motors, data centers, and grids. Right now, the choke point is shifting. The scarce asset is not always the ore. It is the power to process it on acceptable terms. And in my view, this is one of the clearest examples of how commodity markets can look tight on the surface while being deeply imbalanced underneath. People hear copper shortage and imagine every part of the chain making easy money. That is not how real industrial systems behave. The mystery starts with a simple contradiction. Demand for copper keeps rising because electrification needs huge volumes of it. The International Energy Agency has repeatedly warned that energy transition technologies are metal hungry. A battery electric vehicle can use more than twice the copper of a conventional car. Grid expansion uses even more. So why would smelters, the middle factories in this story, lose pricing power? Because too many of them were built for a world that did not arrive on time. China expanded smelting capacity aggressively for years. Indonesia pushed downstream processing after its ore policy shifts. New projects were planned around the assumption that mine output would keep pace. But mines are slow, political, and geological. You can't order a giant copper deposit the way you order another furnace. Treatment and refining charges, usually called TCRCs, are the clearest signal. On the first mention, think of them as the processing toll. A miner ships copper concentrate to a smelter. The smelter turns that semi-processed material into usable metal and keeps a fee for doing it. When concentrate is abundant, smelters can demand higher fees. When concentrate is scarce, miners gain leverage, and those fees collapse. That collapse is not theoretical. Benchmark copper concentrate treatment and refining charges for 2025 were reportedly settled around $21.25 per metric ton and 2.125 cents per pound, according to reporting by Reuters on the annual benchmark negotiations. That is dramatically below levels seen in healthier years, and far below what many smelters were built to tolerate. Spot charges in parts of the market fell even lower, with industry reporting showing near zero and sometimes negative conditions in practical terms, once side payments, impurities, and contract details are considered. So yes, the world can be short copper and still have smelters effectively fighting for scraps. That is the paradox. It is like opening too many slaughterhouses when the cattle herd is shrinking. The retail meat price may still rise, but the processors start underbidding each other just to keep the lines running. Industrial overcapacity does not cancel scarcity. It redistributes the pain. China sits at the center of this. It already dominates refined copper output. And according to the U.S. Geological Survey and industry estimates, it accounts for roughly half of global smelting and refining capacity. That concentration matters because a smelter is not just a factory, it is a geopolitical bargaining tool. If you control processing, you influence trade flows, byproduct recovery, and who gets squeezed when the feedstock gets tight. But this was only the visible layer. The deeper issue is that smelters do not earn money only from TCRCs. They also monetize sulfuric acid, precious metal byproducts, and sometimes local policy support, power arrangements, or strategic financing. That means some plants can survive on economics that look irrational from the outside. They are not pricing like standalone businesses. They are pricing like nodes inside a national industrial strategy. In 2024 and 2025, several analysts and Reuters reports pointed to Chinese smelter expansions continuing, even as concentrate supply looked strained. Why keep adding capacity into a margin squeeze? Because shutting down a smelter is expensive, restarting one is difficult, and market share in processing can be more valuable than short-term profit. If you believe future mine supply will catch up, surviving the bad phase becomes a strategic bet. I think this is where many casual observers miss the story. They treat copper as one price on a screen. But there are really several copper markets stacked on top of each other. Mine supply, concentrate availability, smelting capacity, refined metal demand, scrap flows, and financing conditions. Tightness in one layer can coexist with desperation in another. Have you noticed how often headlines flatten those layers into one simple narrative? That simplification hides where power actually sits. And power in this market is moving. Miners with clean concentrate suddenly have leverage. Smelters with excess capacity lose it. Countries that promised downstream industrialization discover that building furnaces is easier than securing feedstock for 20 years. Chile and Peru still matter enormously because mine supply remains concentrated there. The Democratic Republic of Congo matters because output growth has been strong, but logistics and political risk remain real. Indonesia matters because resource nationalism changed the processing map. Then came the timing problem. Major miners have faced lower ore grades, permitting delays, water constraints, labor disputes, and rising capital costs. Reuters, the Financial Times, and company filings have repeatedly highlighted how hard it has become to bring large copper projects online quickly. Even when copper prices are strong, new mines can take a decade or more to permit and build. A smelter can be planned on an industrial timetable. A mine obeys geology and politics. That gap between industrial ambition and geological reality is the real crisis. The world did not just underinvest in copper mines, it overestimated how smoothly mine supply would feed a much larger processing system. In other words, the shortage is not simply not enough copper. It is not enough mine-ready concentrate for the amount of smelting capacity already built. But wait, there is a twist almost no one outside the trade talks about. When TCRCs collapse, the pain does not stay inside smelters. It can distort the entire chain. Some smelters cut output. Some accept worse economics to preserve relationships. Some chase lower quality concentrate with more impurities, which creates technical and environmental complications. Suddenly, the question is not just who has copper. It is who can process difficult material without destroying margins or breaching regulations. And that changes the value of technology, environmental permits, and location. A modern smelter with strong sulfur capture, byproduct recovery, and cheap power can survive longer. An older plant with weak economics becomes vulnerable fast. Bloomberg and Reuters have both noted periods when Chinese smelters discussed coordinated maintenance or production restraint because concentrate economics had become so punishing. That is a warning sign. When processors start talking about discipline, oversupply has already become painful. There is also a hidden consumer angle here. If you are building data centers, electric grids, charging networks, or defense systems, you do not care only about headline copper prices. You care about whether refined metal production stays stable. A breakdown in smelter economics can create volatility between concentrate scarcity and metal availability. The metal that powers electrification depends on a middle layer most people never think about. And honestly, I find that fascinating. We are told the future runs on copper, which is true. Yet the market structure underneath looks less like a smooth green transition and more like a knife fight over toll booths. Does that sound like a system designed for resilience or a system designed for periodic shocks? The why now is crucial.